SPY falls from the heights in pre-market trading but catches itself on the way down. The bulls and bears are now locked in a struggle with SPY precariously at a critical level. There are high stakes for SPY over the next few trading days. So why did this happen? Before we can explain it, let's turn back the clock a few days. From a weekly perspective, we have this big cup and handle. Everybody's watching it, and everybody knows that 460 is the critical breakout level. Bulls want to close a weekly candle over it, and bears want to reverse down for a triple top. The area 460 is the battleground for the bulls and bears. It's the territory that must be won or lost. 460 is for all the marbles. Above it, we go higher. Below it, we may free fall back to 440, 410, or who knows. So, then on the daily chart, we had this nice long run-up in a fairly tight channel with a full few pullbacks along the way. Price action broke the trend line, but that was to be expected as we saw smaller trend candles the closer we got to 460, which indicated waning momentum. Sellers coming in because they knew that 460 was a key resistance level, so smart money took some profits as we approached that level. That resulted in a week-long price channel. We got a fat red candle on the 29th. Now, some price action traders like myself interpreted the second bull candle after the pullback as a high one entry trigger and took an aggressive entry. Aggressive because the 460 level looms overhead as resistance, and the risk always was that the price would reject down from that level and we would be locked in a range war, which is exactly where we are. You can see bulls defending the bottom of the range. We have a double bottom, but you can also see that bears, also known as sellers, have come in to sell off any breakouts over the range. Why is that? Well, a major reason is that 460 level. As the price action tries to approach that, shorts come in and scalpers come in. There's just not much confidence that the price action can faithfully break over that and hold over 460. So people are selling their shares as it approaches that level. So the safest play in a range is a scalp. As the price moves up to the top of the range or above it, you sell. And as the price approaches the bottom of the range, you buy. And you ride that back and forth until the range is broken. And that's what's happening. So here's the battle map. Range traders are selling and shorting at the top of the range and buying at the bottom of the range. If it breaks and closes below 453, then that not only invalidates the double bottom, but it also starts to trigger stop-loss orders. Experienced traders won't put their stop-loss, though, right at 453.50, but they'll put it a tick below it, so that maybe if price action has a 15-minute or 1-hour candle close below, say, maybe 452.99, that's where we'll see those stop-loss orders start to flood in. So if we get into that territory, it's likely to be a bloodbath. Stop losses are going to get triggered, and shorts will smell blood in the water, and we could see a pretty big sell-off. If we break beneath that, there's a good chance we close that gap down to 441. That's the next obvious level, and markets do like to close these gaps. On the flip side of that, if we get a break over 460 on volume, and maybe a decisive move and close over that, that's going to trigger buy orders. And it's going to trigger buy orders from the shorts, and it's going to trigger buy orders from, FOMO buyers. Bears are going to get crushed. Anyone who has shorted this stock is going to be forced to buy it over 460, and again, those FOMO orders are going to start rushing in. Why? Because the next stop is 480 and all-time highs. That's the next obvious technical level. So that's where we're at. My perspective is this. Since I'm long on an aggressive buy here at that high one candle, there's no reason to abandon my bullish position until we indeed break below 453. A safer play might be to abandon my position and simply range trade. However, the more times a range and its levels are tested, the more likely that level is going to break. Support and resistance levels can only be tested so many times until they fail. And I don't like moving in and out of a trade. It's emotional, and that's how you chop up your account. So what do I think is going to happen? It seems likely that we might test this 20-day moving average at some point, but the longer price action stays at or near 455 to 460, the higher that 20-day moving average gets pulled. Sideways action in this case is good for the bulls. It allows time for the market to take a breather and for that moving average to catch up. Right now, that 20-day is sitting at about 448. About a week of sideways action would bring it up to 455 or so, allowing for a retest while it stays in the range, at which point the market will have caught its breath and it will be ready for another go at 460 or higher. Unless we get a catalyst this week, I would think that for technical reasons we'll continue sideways action. Of course, there's no guarantees, but that's why we have stop losses. About half the time we're wrong. Good traders are right 60% of the time, and more importantly, they're not emotional with their decisions. They got a set of rules, and they stick to them, which is what I'm going to do in this case. All right, as always, this video is not financial advice and is for entertainment and educational purposes only. This is my personal analysis, and you should always do your own research and make decisions based upon your own analysis. Thanks for watching. Like and subscribe.